Welcome back. Today's discussion is for those who follow the Iraqi dinar closely and want to understand what is actually happening, not what is being exaggerated or dramatized online. The information we're walking through is grounded in observable market behavior, reported exchange rates, and how real banking systems function in practice. There is no urgency being manufactured here, and there are no shortcuts being promised. The goal is clarity, perspective, and responsible preparation. On Wednesday, the US dollar exchange rate showed stability against the Iraqi dinar in Baghdad, while easing slightly in Erbil. According to figures reported by Shafaq news agency, the central currency exchanges in Baghdad, specifically Al-Kifa and Al-Harithia, opened at 144,250 dinars per 100 US dollars, unchanged from the previous day. In the retail exchange market across Baghdad, selling prices were observed at 144,750 dinars per $100, while buying prices settled at 143,750. In Erbil, the selling rate reached 143,250 dinars per $100, with buying prices near 143,200. At first glance, these numbers may seem routine, even uneventful. And in many ways they are. But for those who hold Iraqi dinar and track its movement over time, small shifts and periods of stability often generate questions. Is stability a sign of control, pressure, or transition? Does a slight difference between Baghdad and Erbil matter? And how should holders interpret daily movements without falling into rumor-driven narratives? To answer those questions properly, we need to step back and look at how currency markets like Iraq's actually function. Exchange rates in Iraq are influenced by several overlapping factors, including central bank policy, dollar inflows from oil revenue, regulatory enforcement on currency auctions, regional demand, and broader geopolitical pressures. None of these operate in isolation, and none of them change overnight in dramatic fashion. When rates stabilize over multiple sessions, as we've seen in Baghdad, it usually indicates that the Central Bank of Iraq is actively managing supply and demand. This management can include adjusting dollar auctions, tightening compliance on money transfers, or coordinating with commercial banks to ensure sufficient liquidity in the local market. Stability does not automatically imply appreciation, and it does not signal an imminent change in regime. It simply reflects balance at that moment in time. The slight easing in Erbil compared to Baghdad highlights another reality that often gets overlooked. Iraq's currency market is not perfectly uniform across regions. Differences in trade flows, enforcement intensity, and regional banking practices can create small spreads. These differences are normal in developing and transitional markets. They do not represent secret signals or hidden messages. They are simply reflections of local market dynamics. For holders watching these numbers from the United States or other countries, it's important to resist the temptation to assign dramatic meaning to daily fluctuations. Currency markets move for practical reasons, not emotional ones. And while online commentary often frames every movement as a sign of something about to happen, professional financial analysis looks at trends over time, not isolated data points. This brings us to an important distinction that must be made clearly: the difference between verified financial processes and unverified narratives. Verified processes are those that can be observed through official reporting, central bank statements, regulatory actions, and consistent market behavior. Unverified narratives, on the other hand, often rely on unnamed sources, private messages, or claims of insider knowledge that cannot be independently confirmed. In the dinar community, unverified narratives often circulate rapidly, especially during periods of market attention. They may reference special access, hidden timelines, or exclusive groups. While these stories can sound convincing, especially when wrapped in technical language, they are not supported by how modern banking systems operate. In reality, international currency systems function through transparent, regulated processes. Banks do not activate secret exchange windows. Central banks do not conduct covert revaluations for select individuals. Exchange rates are published, regulated, and applied uniformly within the framework set by monetary authorities. Any significant change in currency policy is reflected in official channels, not whispered through private alerts. Understanding this reality is not meant to discourage holders, but to protect them. The greatest risk to individuals holding foreign currency is not missing an opportunity. It is acting on misinformation and exposing themselves to fraud, legal trouble, or unnecessary financial stress. That is why preparation should always focus on fundamentals, not speculation. Responsible preparation means understanding documentation requirements, knowing how banks verify transactions, and being aware of legal and tax obligations in your country of residence. These steps are relevant regardless of whether rates move quickly or slowly, and regardless of whether market sentiment is optimistic or cautious. At its core, currency exchange is a regulated financial transaction. Banks are required to follow Know Your Customer and anti-money laundering standards. This means they must verify identity, confirm the source of funds, and document transactions accurately. These requirements are not unique to the Iraqi dinar. They apply to all significant currency exchanges globally. For a holder, this means maintaining clear records of how and when currency was acquired. Receipts, invoices, bank statements, and correspondence with dealers all serve a purpose. Even if some records are incomplete, organizing what you have now is far better than attempting to reconstruct history later under pressure. Documentation is not about suspicion. It is about compliance. Liquidity is another term that frequently appears in discussions but is often misunderstood. Liquidity refers to the ability of financial institutions to meet demand for currency exchanges without disruption. When banks assess liquidity, they are ensuring that they can honor transactions smoothly while maintaining regulatory balance. This process happens continuously, not suddenly, and it is adjusted based on market conditions. In Iraq's case, liquidity management is closely tied to oil revenue, dollar inflows, and the central bank's policy tools. Changes in enforcement, auction volumes, or cross-border transfers can affect short-term rates. But these are policy adjustments, not signals of imminent windfalls. For international holders, especially those in the United States, legal considerations are equally important. Currency exchanges may trigger reporting requirements depending on transaction size and structure. Banks may ask questions, not because something is wrong, but because regulations require them to do so. Consulting a qualified tax or financial professional before engaging in large transactions is a prudent step, not an overreaction. Another critical area that deserves attention is the risk of scams. Periods of heightened discussion around any currency tend to attract bad actors. These scams often promise priority access, special rates, or expedited processing in exchange for fees or personal information. Legitimate financial institutions do not operate this way. They do not charge for access, and they do not communicate through unsolicited messages. Protecting yourself means verifying information directly with official sources, avoiding pressure tactics, and refusing to share sensitive details outside secure, verified channels. Patience and skepticism are valuable tools in financial decision-making. As we continue this discussion, the focus will remain on realism and responsibility. The Iraqi dinar market, like all currency markets, evolves through policy decisions, economic conditions, and regulatory enforcement. It does not move according to rumors or countdowns. Understanding this helps holders maintain perspective and make informed choices. In the next part, we will continue by looking more closely at how international holders can think practically about timelines, what realistic monetary reform processes look like historically, and how to stay grounded while navigating ongoing market discussions. As we move deeper into this discussion, it is important to address one of the most common areas of confusion for international currency holders, especially those based in the United States: the concept of timelines. In online discussions, timelines are often presented as short, dramatic windows that imply urgency or exclusivity. In real financial systems, timelines function very differently. They are shaped by policy coordination, regulatory compliance, market readiness, and international oversight. These processes unfold gradually, often unevenly, and rarely according to publicly advertised schedules. Historically, When countries adjust currency policy, whether through reforms, redenominations, or managed exchange mechanisms, the process unfolds over months or years. Central banks communicate changes through formal announcements, regulatory updates, and coordination with international institutions. Even when a policy shift is significant, its implementation is typically staged to ensure stability and prevent disruption. There is no practical mechanism for a modern banking system to execute sudden, hidden, or selectively accessible currency changes without creating regulatory and market consequences that would be immediately visible. For Iraqi dinar holders observing daily rate movements, this historical context matters. Stability at a certain range, such as what has recently been observed in Baghdad, does not indicate that a sudden shift is imminent. Instead, it often reflects active management. The Central Bank of Iraq has spent years working to stabilize the currency, control inflation, and manage dollar flows. These efforts are aimed at maintaining economic balance, not triggering speculative surges. Another point that deserves careful attention is the difference between internal policy discussions and public financial outcomes. Governments and central banks routinely analyze potential reforms internally. This includes modeling, scenario planning, and stress testing. However, internal analysis should not be confused with imminent action. Many ideas are explored that never reach implementation, or that are implemented only after extensive adjustment. Assuming that internal consideration equates to immediate execution is a misunderstanding of how institutions operate. For holders outside Iraq, particularly in the U.S., this distinction becomes even more important. International banking systems rely on clear, documented policy changes. U.S. financial institutions operate under strict federal regulations. Any change in how a foreign currency is treated must be reflected in published rates, compliance guidance, and system updates. Banks cannot legally process special arrangements or unpublished rates. Everything must align with regulatory standards. This brings us back to the role of preparation. Preparation is not about rushing. It is about readiness. Readiness means knowing where your currency is stored, understanding how to transport it securely if necessary, and having documentation organized. It also means understanding your local banking environment. Not all banks handle foreign currency exchanges, and those that do may have specific procedures. Knowing this in advance saves time and reduces stress. It is also worth discussing the psychological side of holding a long-watched asset. Many individuals have followed the Iraqi dinar for years. Over time, anticipation can turn into emotional investment. Emotional investment can cloud judgment. This is why disciplined thinking is essential. Financial decisions are best made when emotion is minimized and information is verified. One way to maintain discipline is to separate information into categories. Verified information comes from official sources, such as central bank statements, reputable news agencies, and published exchange rates. Analytical interpretation comes from economists and financial analysts who explain trends without making promises. Speculation, by contrast, often relies on unnamed sources, dramatic language, or claims that cannot be independently checked. Recognizing which category a piece of information belongs to helps maintain clarity. Scams tend to thrive where speculation dominates. Fraudsters often imitate official language, use urgent tones, and claim insider access. They may reference legitimate institutions while providing fake contact details or unofficial websites. The safest approach is always to initiate contact yourself using verified phone numbers or websites, rather than responding to unsolicited messages. No legitimate institution will pressure you to act immediately or threaten loss for inaction. Tax and legal considerations are another area that requires practical thinking. In the United States, currency exchanges can trigger reporting obligations depending on the amount and structure of the transaction. Banks may file reports as required by law, and individuals may need to report gains. These requirements are not punitive. They are standard compliance measures. Understanding them in advance helps avoid surprises. Consulting a qualified professional is often misunderstood as unnecessary or premature. In reality, a brief consultation can clarify obligations and prevent costly mistakes. Professionals can explain thresholds, documentation expectations, and best practices for record keeping. This guidance is especially valuable for those dealing with foreign currency, where rules may differ from domestic transactions. As discussions around the dinar continue online, it is helpful to remember that markets respond to policy and economics, not community sentiment. While online interest can influence short-term behavior in some asset classes, currencies are primarily driven by trade, reserves, and governance. Iraq's economy, oil revenue, and fiscal policy all play roles in shaping currency outcomes. These factors change gradually and are influenced by global conditions. In practical terms, this means that patience is not passive. Patience is an active choice to wait for verified information while maintaining readiness. It involves monitoring reliable sources, organizing documentation, and staying informed without becoming overwhelmed. It also means accepting that some questions cannot be answered immediately and that uncertainty is a normal part of financial markets. As we approach the final part of this discussion, the focus will shift toward consolidating these ideas into a clear, responsible mindset for holders. This includes how to stay informed without becoming reactive, how to evaluate future updates critically, and how to maintain personal responsibility regardless of market developments.